lot, Nir. So, and thanks to everyone for inviting me to your very specialized seminar on decentralized finance. So I'm very honored to present in the front of targeted audience. Of course, I will go through basic terminology and introduce decentralized exchanges. So if someone if this is new to someone, but yeah, as feel free to interrupt me with any questions. So basically this work is my recent work with Amit Chaudhary and Basil Kaparos, who are my co-authors from fintech industry. And Amit is also a research fellow at Gilmore Center for Financial Technology. Yeah, the paper is on blockchain scaling and liquidity concentration on decentralized exchanges. So, I mean, all of us heard, of course, of the infamous collapse of FTX in early November last year, and Sam Bankman-Fried is currently standing trial for misappropriating customer funds. So at least, according to Reuters, at least $1 billion of customers' funds vanished. So, but basically, we see the collapse of the FTT token. So, but the important thing of this is that, FTX, together with other exchanges or competitors like Binance or Coinbase, they're actually centralized exchanges, okay? So we say centralized because, they operate a limit order book. So everything is executed on exchange server, and in limit order book, orders have to be matched. So if you would like to submit a buy trade, your incoming market order will have to be matched with outstanding limit order from a particular trader. So there is a search for counterparty base, even though it's really quick and it's matched automatically, but there is search. And importantly, they keep the custody of clients' assets. So that was, it's not a problem in itself, unless, of course, the customer's assets are mishandled. So like on FTX. So here below on the figure, you see this is the snapshot of a limit order book from Binance Spot BTC USDC pair. And it's just to show you, I mean, it's basically same as on traditional exchanges, London Stock Exchange, New York Stock Exchange. Yeah, there's nothing new. It's only that cryptocurrencies are traded in the limit order book. So the new concept, the new type of exchanges are the so-called decentralized exchanges that have recently gained in popularity, and they operate directly on blockchain. So they use the so-called smart contracts or pre-programmed rules. So the idea here is they are organized as automated market makers or AMMs. So if here now you would like to trade, so then if you submit your kind of market order, which is actually called a swap in this terminology, so then it's gonna be executed against the unique counterparty, which is the liquidity pool, if you like. So that is the automated market maker. So there is no need for matching or search for counterparty. Your order is exactly, or your trade is executed against the liquidity pool. And importantly, so why they become so attractive? Because users can keep custody of their own assets. Settlement is also very quick. So basically, they have higher level of security for clients' funds. So, and this ultimately, so they keep that the users can keep custody of their own assets and the much quicker settlement and efficiency. So these are the real advantages of decentralized exchanges. So that's why currently they are only used to trade cryptocurrencies. But of course, there is lots of talk going on tokenization. So basically tokenizing all financial assets and bringing them trading on the blockchain. Okay, so they are provide higher security, but higher security, of course, like many things in this life, comes at a cost. So what are the disadvantages? Currently, transaction speeds on decentralized exchanges are slower. So all transactions have to be validated before they're recorded on the blockchain. But also users of blockchain have to compensate validators with gas fees. So basically, like, this is a fixed cost for any transaction on the blockchain. And importantly, like for our at least setup, so by user, we mean anyone who would like to execute transaction on the blockchain. So it's not only if you would like to actively trade, to submit a buy trade or a sell trade, obviously you have to pay exchange fee, but also on top of that comes gas fee. But also as a liquidity provider, like if you would like to deposit liquidity in the pool, if you would like to do this market making, you will have to pay the gas fee for every mint, like or liquidity deposit or burn. If you withdraw your liquidity from the pool, you burn it, so you also have to pay the gas fee. So they essentially act as a transaction tax. So here, like this graph, I mean, I'm not going to go into detail. This is just to show you, of course, this is monthly trading volume. It's quite volatile. So you see in 2021, especially in May 2021, it reached its boom and around $200 billion. So basically, the dark blue bar shows us the largest exchange, or the exchange with the largest market share, which is Uniswap. Yeah, and that's why we basically concentrate our analysis on Uniswap, which is now on the latest version v3, because this is the main player in the market. So currently, of course, there's been Uniswap v4 announced, but it's not implemented yet, at least. So Uniswap v3 is still the latest version. And so on this Uniswap v3, if you compare to Uniswap v2, so in the previous version, Uniswap v2, the only decision you could take as a liquidity provider is whether to deposit liquidity or not. But if you decided to deposit, you had to deposit like your so you didn't have any control over the price. Okay, so your whole liquidity was distributed on the whole price support, like from minus infinity to plus infinity. So that's basically not that efficient. So on Uniswap v3, what's different? You can now choose the price range. So you can set the lower price PA and the upper price PB, on which your liquidity position is going to be active. So I will show you like the Uniswap dashboard later on, but basically like you have control over the price range at which you are providing liquidity. Okay, so the price curve for Uniswap v3 is just like modifications of simple x, y equals k. So this was for Uniswap v2. So we are not, I'm not like in the interest of time, I can go into detail here, but basically, yeah, it's almost equivalent to this constant product function. Yeah, so just introduces virtual reserves. So tokens are no longer deposited in 50-50 ratio. So previously in Uniswap v2, well, if you say deposit 5 ETH and each ETH is worth 1,000 USDC, so you would have to deposit 5 ETH and 5,000 USDC. So you had to always provide 50-50. Now in Uniswap v3, the amounts deposited, they actually depend on the position of the price range relative to the current pool price. So that's here now example of this Uniswap dashboard. So suppose you decided like, okay, I want to act as liquidity provider. And so you go to the dashboard. This is for the specific pool, USDC ETH 0.3%, so which is one of the most liquid pools, but it's not the most liquid pool. So 0.3%, of course, like why you provide liquidity, because you want to gain rewards. So for each trade executed in the liquidity pool, you will get 30 basis points reward. And here you can play around then on the price range. So this shows it. Sorry. So So if you see on the graph, there is like in pink, there is this liquidity distribution around the current price. So the current price is marked by vertical black line, yeah, and then with this like below you can set minimum price, maximum price, and you can play around with it. So in this example here, you can even provide liquidity, so not only centered around the current price, but you know, well above the current price or well below. So in this current example, then if your price range does not include the current price, for example, then you even have to deposit. So in this case, if the price is above only token X, so which is USDC. If it would be just below, then you would have to deposit only ETH. If your price range includes the current price, then you have to deposit both. And in a specific amount, like which Uniswap calculates for you, which depends on the skewness of your position, like whether it's metric around the current price or not. Okay. So, and now we like
Olga, I think there is a question in the chat if provider can adjust their price range.
Can provider adjust? So yeah, and this is yes. So the answer is yes, and this is like exactly like you're a bit ahead of me. So let me just go through this numerical example, and we will see that this is exactly what is happening, and this is like what it lies like, you know, what is the main point, like our main research question in the paper. So let's first assume like without, you know, like without any updating, without any adjustments. So how do you make money on Uniswap v3? Basically, say you deposited a single position, you denoted your lower price and upper price. And suppose you are the single liquidity provider in the market. So then the buy trade comes in, so which is for $10,000. It moves, like automatically moves the price to the higher level because there is like this automatic built-in price impact because of this constant product market making formula. So, but as long as the order flow is balanced, suppose then there is a sell trade comes in for 10,000K. So the price, market price will move exactly backwards to where it was. So that's why position initial value will be the same as final value. So your portfolio of ETH and USDC reserves that you have deposited will be exactly the same, but you have made $10 on this trade because for each trade of 10K, you get 5 basis points. So this is how, like, why you actually want basically to provide liquidity to earn those rewards. And all of this is fine as long as the order flow is balanced. So now, okay, so somehow I can't move to the next slide. So just a second. I think I have to switch to present. Yeah, okay. Okay, so, but of course, there are risks, yeah? So what if the order flow is not balanced? So what happens then? So suppose, again, you deposited like your initial position of $1 million, and suppose you just put it symmetric around the current market price of 1,000. So in which case you just split, actually you do split 50-50 because you are symmetric around the current price. So you deposit 500 ETH, 500 USDC. So then externally, say on centralized exchange, so the price of ETH moves. So it experiences permanent increase. I mean, this is very stylized. So just like huge numbers, so from 1,000 to 2,000. So, but this is just to show what happens. So suppose the price has permanently increased, and then if you are not monitoring, not updating your position, then basically you are adversely selected by arbitrageur trades that are start coming in. So eventually arbitrageurs will start coming into the market, and what they will do, they will start depleting the ETH reserves in your position. So the ETH price now has become more expensive, but you are still offering it at 1,000 or between 1,000 to 1,100. So your ETH is too cheap and you are adversely selected by arbitrageur. So at the end, what you will get, you will be only left with 1 million of USDC. So you will have sold all your ETH. Yes, you still have 1 million as before, you would think, but if you would just keep holding your position, then because the ETH price has appreciated, you would end up with 1.5 million, even like if you didn't do anything, just kept holding to your initial ETH and USDC portfolio. So that's why we say, okay, so in this scenario, you are experiencing adverse selection loss of 500,000. So in the industry, they often refer to this as impermanent loss. So this is like kind of their terminology. However, like we have to be careful. So these losses can be very, very permanent. So, and this is very misleading, actually, this term of impermanent loss. So that's why we basically refer to it as adverse selection loss in our paper. So this is the basic kind of setup. So you earn rewards, but you can be adversely selected. So, but of course, as a liquidity provider, you are rational and you foresee that such risk. So how could you potentially protect yourself? So one scenario would be like, okay, so what you could do potentially is redistribute the same amount of your initial capital, so also $1 million, on a wider price range. So suppose you just redistribute between 500 and 2,000. So, and you see the bar got flatter here on the picture. So this is to say, okay, now your position is less concentrated because, I mean, the amount of capital is still the same, but just spread across wider price range. In this case, yes, your final, again, so the arbitrageur submits a buy trade and you are adversely selected again. So you are doing a little bit better than previously because your final value you see from this graph is 1.2 million. So this comes, like the intuition comes from the fact that you have sold some of your ETH at more expensive prices. Yeah, so now you see your position even includes the new market price, say, of 2,000. Yeah, so you sold more, like your average execution price is higher, but it did not protect you. So because if you would have like just held your initial portfolio, you would still be better off like with 1.5 million. So you again, you have adverse selection loss, it's lower. So yeah, you are protecting yourself partially, but not fully. So, and what else could you do actually? So, and this goes back to the question in the chat from before. Well, you could actually update your position. Yeah, you could adjust your position. I can adjust my price range. So suppose like you are a professional market maker or liquidity provider, and you continuously monitor. So of course, like this has the assumption that you continuously monitor like externally also the prices of the ETH, and you know like that this permanent price change has occurred and the new price is 2,000. So then what you could do is actually burn your previous position or withdraw your liquidity from the pool and repost it around the current market price. So, and if you manage to do this before the arbitrage trades coming in, so we don't necessarily like say that you will always be able to do, because at the end, like we don't know, of course, like it depends on the position in the final block. But if you are a professional liquidity provider, you can, and you update quickly, I mean, there is a good chance that you can update before the arbitrageurs start coming in. So the final value of your position then will be actually 2 million. Yeah, this is because, I mean, you have avoided adverse selection at all, and you are currently selling ETH at much higher prices. So you are doing even better than if you just keep holding your position. So in that case, you are actually making profit of 500K. So it's here it says, oh, impermanent loss is negative, but this actually means, so you are making profit on it. Okay, so that's of course the first best scenario. So if you could always potentially update, this is the way to go. However, as we discussed before about these gas fees, the problem is that updating is costly. And every time you have to update, I mean, except that you have, of course, to continuously monitor the market, but for each transaction, for each burn, and for each new mint, so for 2 transactions, you have to pay gas fees. So this means, yeah, basically this is costly. So there can be 2 scenarios then. So this is what our paper, basically the research question is, in our paper. How does this frequency of position updates affect liquidity concentration on decentralized exchanges? So we refer like to these 2 terms. Repositioning intensity is the same for us as frequency of position updates. And there could be 2 scenarios. So if it is costly, so if updating is costly, if there are high gas fees, then of course we expect less updating. And then we expect, of course, the rationale, if I know it's very costly for me to update, yeah, so then, I mean, at least I will try to do something to protect myself from adverse selection. So, and the best thing I could do is to set wider price range. So this would correspond to our previous scenario with these flatter bars. Yeah, so you can protect yourself still to some extent by setting wider price range, but setting wider price range means that on aggregate, if everybody sets this wider price range, the aggregate liquidity distribution is less concentrated around the market price. Okay. So we expect then lower concentration of aggregate liquidity around market price. And on the other case, so what happens if there are like scenario with low gas fees? So if updating becomes less costly, then the opposite occurs. We expect more frequent updating. So then you just like, okay, you are okay to pay this low gas fee every time and to update your position. You will then set narrower price ranges because you want to concentrate your position to be able to earn higher rewards. And this will result in the higher overall concentration of aggregate liquidity. So this corresponds to our last scenario where you are actually able to update before arbitrageur snipes you. Okay.
Can I ask a question?
Yeah. Sure.
So, can you give us some idea about the magnitude of, let's say, for example, here the impermanent loss is, let's say, negative 500K. That means I'm earning 500K. But in this case, let's say what a high fee or what a low fee would correspond to some numbers. Like, is maybe the impermanent loss, it's going to strictly dominate whatever gas fee that is going to incur. So high, low doesn't make much difference, or it actually could potentially be very different.
Yeah, so that's kind of, I think it's like, so it's like a continuum of possible states. So we are going to look at the state when these high and low gas fees are so different, then they do make a difference. But I mean, I agree with you, so that there can be some, scenarios or some like parameters where if, okay, so just slightly lower gas fee, will not like fully protect you, yes, from impermanent loss. So, but I mean, I'll show you some numbers, what we mean by high and low gas fees, like basically very soon in 2 slides.
Thank you.
So the, okay, so we would like basically to test the link between causal link between like how frequently they update their position, so repositioning intensity and the liquidity concentration, the aggregate liquidity concentration in the pool. And the problem is that, I mean, you could easily, what you could do is you run a regression. So you just regress liquidity concentration on repositioning intensity. But the problem is it's potentially endogenous. So because repositioning intensity, so or like this willingness of liquidity provided to update his position may in itself depend, say, on liquidity concentration in the pool and a bunch of other factors. So what we do to identify this is we use the launch of Uniswap v3 on the competitor, like this Polygon proof of stake blockchain, basically. So, and until then, until when Polygon entered, the incumbent blockchain was Ethereum. Actually, there was also entry of Arbitrum in between, which we are currently updating to as well, our data. But like when Arbitrum just launched, there was not so much trading going on. So as opposed, like recently, there's been an upgrade. So then now they are leading and ahead of Polygon. But when Polygon entered, I think they were the main competitor. Okay, so so this was the scaling solution. So let me show you basically the numbers. So the average gas fees for a trade on Uniswap on Ethereum in our sample, which is the whole year of 2022, so January till December 2022, is $14. Whereas on Polygon, it is just $1.00. So which is like a very big improvement. So the same for transactions per second. On Ethereum is up to 30 and on Polygon is up to 700. So it's like a huge increase in throughput and like a large drop in the gas fees. So that's why, I mean, we claim that, okay, so the entry of Polygon is actually associated with exogenous increase. So the gas fee was so low that you do see lots of updating happening. So it's exogenous increase in repositioning intensity. Okay, so let me just this is a snapshot of main findings. So before I go through all regressions in detail, so this is the snapshot of what we find. So that actually, if you look at Ethereum versus Polygon, what do we see? We find that Ethereum has a greater market depth and which is related to higher security. Yeah, and like we have papers by Nir and Kite about like this estimating investor preferences for security. So basically, we know that security matters to investors, and Ethereum security is high because it has higher number of validators, and that's why we still see greater market depth on Ethereum. But what is interesting for us is like, okay, but then who is using Polygon and why? And we find that on Polygon, there is lower slippage or price impact, if you like, for smaller trades up to 10,000. So first of all, we see that in generally only small trades mostly happen on Polygon because security is just not like of that major concern for smaller traders and smaller liquidity providers. And then, I mean, even in absence of gas fees, so yeah, of course, like gas fees are much higher on Ethereum than on Polygon, but even in absence of gas fees, so even if the gas fees were absolutely the same, so the slippage just comes from this liquidity distribution around the current price. And we see that the small trades on Polygon, they have lower slippage. Then we were then like, okay, so why is this the case? So, and apparently, of course, this has to do with it, that the liquidity concentration, that the liquidity is more concentrated around the market price on Polygon. So which then automatically like translates into lower slippage. For small trades. Of course, for large trades, like the most important criteria is the total aggregate market depth, which is much higher on Ethereum. So, and then finally we run, like we say, okay, so now we know there is higher liquidity concentration Polygon, but why? And then we run these instrumental variable regressions to test whether there is this causality between frequency of updating and this higher liquidity concentration. So, and that's what we basically find, that because like this lower, much lower gas fees on Polygon, they lead to higher frequency of updating and to higher liquidity concentration. It's not only that they update frequently, but they also do so at the correct price, because I mean, you can update, but it can be all over the place. Yes, so it's not necessarily that you update at the new market price, but that's why we look at something we call precision of repositioning. So basically how correctly you reposition. So, and we do see that, yes, their positions tend to be like when they update, more concentrated around the current market price. So this is the current literature. So let's skip. So I mean, it's on Uniswap v2 is more established. On Uniswap v3 still like several papers already, but quite few like empirical papers yet. So mostly theoretical. Okay, so, and now I'm just gonna go quickly. I mean, how much time do I have still? So
About 20 minutes.
20 minutes. Okay, so then I know. Okay, so this will, I will just go through the, you know, more in-depth analysis, but hopefully quickly, so within 20 minutes. So our sample consists of three most liquid pools on ETH pools on Uniswap v3. So we need, like, to do our study, we need that pools like exist on both Ethereum and Polygon and that they are liquid. So to be able to compare them, and therefore there is not that many pools that actually come into question. So, and therefore the benchmark like pool is the most liquid one on both Ethereum and Polygon is USDC-ETH005. So therefore, like these are like benchmark results for us. So these two other pools, yeah, it's like we do find similar findings and so on, but they are, even though they are still quite liquid and one of the most liquid pools on these decentralized exchanges, still they are much less liquid than this top pool. And we cover sample period January 2022 till December 2022 because Polygon has entered, it entered in December 2021, so just 1 month before, but there was previously not enough like happening, so not enough volume traded. So we start with January 2022 and we are currently updating to 2023 and for Arbitrum blockchain. So preliminary findings like look the same basically. Okay, so we start like by looking into trading volume and total value locked or market depth, if you like, on Ethereum and Polygon. So, and without, like, not surprisingly, we find that, well, Ethereum has much larger total volume locked, total value locked, and volume traded. So Polygon is lower, like 17 to 20 times lower, both volume and TVL. And this is due to the security trade-off, yeah? But when you take the ratio of the two, volume divided by TVL, so something like turnover ratio, so you see that they're actually approximately the same. So a volume traded per, you know, per dollar of TVL locked. And you see that, yeah, so this pool 0.05% is much more liquid. So then we look at the trade size. Here we see so that Polygon is mostly used for small trades. So the average trade is around $2,500 on Polygon, whereas on Ethereum, so it's $78,000. But even the median trade, like for Ethereum, it's 5,000, for Polygon, just around 1,000. So you see that Ethereum is used like by large liquidity providers and by large traders. Okay, so this is the trade-off that I already actually explained several times, so that's why I'm not going to go. So it's like this security versus gas fees. So lower number of validators. So why is it less secure, a Polygon? Because it has lower number of validators. So that's why they can, validate more blocks. So generate more transactions per second, but they can offer lower gas fees, but there's also lower security in the sense that there is a higher chance that you can potentially lose your funds. So we see this separating equilibrium, if you like, so that Ethereum has overall larger market depth and larger trades, and Polygon has smaller market depth and smaller trades. So, but then, okay, so having this knowledge like in the background, we start comparing, slippage or price impact of like trades of different sizes across Ethereum and Polygon. So slippage is, we define it as this ratio of average execution price divided by market price and the absolute value. So it basically shows you by how much is your execution price worse than the previously displayed market price. And it will always be worse because there is this automatic built-in price impact on these constant product market makers. But the question is like how much worse it's gonna be. And it has like same intuition like as Kyle's model 1985. Yeah, so slippage or price impact is greater for larger trades and is inversely related to market depth. So, and therefore, I mean, obviously the market depth, we know it's much higher on Ethereum. So there is no kind of surprise there that the slippage is going to be like lower overall for larger trades on Ethereum. So therefore, and this shows our first regression here. So where we, so there is both like the dependent variable is slippage. We estimated each minute from end of minute liquidity distributions. And we have here Ethereum and Polygon. Yeah, and this is just one of the pools, the most liquid one. So you see that on average, slippage is higher on Polygon. Okay, this is no surprise because the market depth is lower there. So then we start differentiating between large and small trades using different cutoffs. I mean, what is large, what is small is subjective, but we use 1000K, 5000K, 10K cutoff. And we see the same picture that for smaller trades. So now the Polygon dummy here, it just captures just small trades because we have additional large dummy and Polygon times large, so the interactive effect of the two. So this Polygon dummy shows us that the slippage of small trades on Polygon is significantly lower than slippage of small trades on Ethereum. And this is important result because it does not even take into account the gas fees anyhow. So it's just like the liquidity distribution. So if you add on the gas fees on top, of course, you will see that then it's even better for you to trade small trades on Polygon. So this comes even on top. So why does it happen? So why is it so? So then we say, okay, so probably because like, let's look at liquidity concentration, yeah? And we define liquidity concentration as market depth within X% of the current market price. So basically, how much liquidity out of total value locked is posted within 1% of market price, within 2%, within 10%. And for example, for Ethereum, for this most liquid pool, you see that 5% of total TVL is posted, 5.21 is posted within 1% of the current market price, and so on. So these numbers, of course, they mechanically increase because, I mean, the further away you go from the market price, the more liquidity will be, posted within this interval potentially. But we are interested in the relative difference between Ethereum and Polygon. And we see that on Polygon, like irrespective of this like band, so 1, 2, 10%, you always see there is more like higher liquidity concentration. So for all bands and across all three pools. And then, I mean, okay, so this explains why the slippage is lower for smaller trades, and this is important for small retail traders. But why does it happen? So then we start looking at, okay, so what happens with this frequency of position updates, of these mints and burns. And if we look on the top pool here, you see, yes, there are more mints and burns on Polygon, but what is probably even more important, like, I mean, it's just number of mints and burns per day. But the value in millions of dollars, so it's even higher than that on Ethereum. Yeah, so $35 million per day minted on Polygon, and 29 million per day additionally minted on Ethereum in our sample. And then you see, like, what is striking is that the same amount is burned on Polygon as well per day, whereas on Ethereum it's much less, it's 1571%. Million. So you see that there is this much more balanced kind of the same amount like minted and burned on Polygon relative to Ethereum. So then we measure a repositioning intensity as this dollar amount minted minus dollar amount burned divided by total volume minted and burned within each 5-minute interval. And the intuition is, suppose like if you minted and then you burned, so then the same amount, yeah? So then this difference will be close to 0. So the ratio will be close to 0, and 1 minus 0, so will be 1. So your intensity will be like 100%. So meaning you have burned as much as you have minted. Whereas if you say just minted and there were 0 burns in this 5-minute interval, then you would have the ratio is 1. And the repositioning intensity will be 1 minus 1, 0. So it should be 0 because there was no repositioning. So it's just like pure minting or adding new liquidity to the pool. So there is a question, right?
Yeah, there is a question in the chat.
So
I think it's the previous
the second and third pills seem to have less repositioning in Poly. So let me show you the statistics on reposition. So they have, so in the sense that they are still more balanced, yes? So they have probably like not that high difference between, so if you see at the number of mints, yeah? So it's like 92 is approximately same as 97 on Polygon. Burns are higher here. Burns are always higher on Polygon, so the number of burns. The value minted and burned indeed is lower for these two other pools, yeah? Because, I mean, they're just like much less liquid, if you like, on Polygon than on Ethereum. But we are not kind of interested in these absolute amounts because then it would be totally unfair to compare like Polygon versus Ethereum. So therefore we scale like everything. So that's why we do this intensity in percentage terms. So relative to how much was minted and burned, what was the difference? And here then, like based on this measure that I just shown you, so then it is indeed higher on Polygon than on Ethereum for all pools. So, but as I said before, so yeah, I mean, I agree. So these two other pools, they're less liquid. So basically the benchmark results are from the 005 pool, and there it's like totally clear what's happening. So intensity, reposition intensity is higher on Polygon. So now we have two different results. Yeah, so we have higher liquidity concentration and higher repositioning intensity. So like now we want to test like, does this repositioning intensity actually cause higher liquidity concentration? And we do it with instrumental variable regression. So using Polygon as our instrument for exogenous increase in this frequency of updating or in this intensity. So we run, you see also from the first stage, so first model shows the first stage regression, so indeed intensity is much higher on Polygon. This is what we have seen from univariate statistics also before. And then we run the second stage regressions. So intensity is then instrumented here with Polygon. And you see that indeed higher repositioning intensity leads to higher liquidity concentration. So irrespective, like 1%, 2%, 10% band. We also redo like this repositioning intensity, not based on 5 minutes, but based on 10 minutes. But you see a same kind of effect. And then we say, and in the last part, like we say, okay, so they update more, but it doesn't mean that they are good at updating, doesn't necessarily mean. So you need to look kind of, do they update also around the current price? And that's what we say, like this precision of positions. So we look first at the position gap. So this is basically how distant, how far away the mid price of your position is from the current market price. So you're minting the position, there is somewhere the price in the middle, the mid price. So how far away is it? So what is the gap between it and the current market price? And you expect then, I mean, if you, so to have the lesser gap, yeah? So to be more precise, you want to be as close to the current market price as possible. And this is what we see on Polygon. So this position gap is lower on Polygon. So there is inverse relation here. Position length, okay, so maybe you post close to the market price, but maybe your position is still very wide. So we also look at the position length, which is just the absolute difference like, between upper and lower price. Again, we see that on Polygon, positions are actually narrower overall. So you see, again, there is inverse relation. So to be more precise, your position has to be more narrow. And then we kind of build like this position concentration, because I mean, okay, so these previous two measures, they have two different dimensions, yeah, but we want to have both like narrow price ranges that are centered around the current market price. So we build this measure of position concentration, which takes into account these previous two measures and is scaled between 0 and 1. So here, like there is a linear proportional range. So higher concentration means like higher, like you are more precise. So, and on Polygon, indeed, you see this higher position concentration of individual positions, yeah? And then finally, we want again to see, okay, so does this precision of repositioning, does it also lead to higher liquidity concentration? So we rerun our instrumental variable regressions, but using these three new measures. And so we find everything is as expected, because like for the gap and length, you expect the inverse relationship. So that's why there is minus here. So the higher gap leads to lower concentration, or wider price range leads to lower concentration, and an opposite narrow price range leads to higher concentration. And this position concentration is basically proportionately related. So it's so higher concentration of individual positions leads to higher aggregate liquidity concentration. We also like sort at the end positions into those that are closed within the same day, like intraday positions and multi-day. And we see that the major effect comes from this intraday position. So indeed, like more repositioning happening. So, and that's basically it. So let me conclude. So I hope I'm not running out of time. So, but basically we show that these blockchain scaling solutions, they allow for more frequent updating by liquidity providers. They can better protect themselves from adverse selection by being able to update more frequently. and then to maximize their rewards, if they're able to update more frequently, they will concentrate their positions around the market price. And then we say, okay, so the higher position in intensity or frequency of updates leads to higher liquidity concentration. And why do we care about this high liquidity concentration? Well, it's important because it reduces slippage of, especially for small trades we see on Polygon. With this, so as of now, these blockchain scaling solutions, they are mostly attractive for small traders and liquidity providers because, they do provide low gas fees, but they are less secure. Whereas Ethereum, I mean, it's still like, even though it will remain there because its pools are deeper on aggregate, because it's more secure, and they provide a definitely better execution terms for large traders. So at the end, we see this, that large traders, large liquidity providers, they end up being on Ethereum. And I think, like, actually, if since the gas fee represents a fixed cost, even in the future, I mean, if you are trading $1 million, so this kind of like $10 or whatever, they are irrelevant to you. So the only thing you care about is security. So I think that potentially even in the future, Ethereum will still be the place for trading like large trades. Whereas blockchain scaling solutions, they are developing, yes, they become better, they become more secure, like Arbitrum and with all these roll-ups solutions, but still, I mean, there is a limit, like, to how much you actually care about this lower gas fee, so they probably remain attractive for small traders. Okay, so thanks. So that's all. I'm happy to answer any questions.